If you take a look at the year-to-date performance of global equity markets, you'll have noticed that the DAX is one of the worst performers because it's most hit by any of these concerns around global trade, in particular around autos. The German automotive industry is actually the biggest exporter of US manufactured cars from the US to China. So if it hits an automotive industry hardest, it's Germany's. And that's why you saw that reaction in today's trading session.
I mean, it went up, but then kind of as soon as the US started trading, the DAX actually ended up going down again. Is that perhaps a reality check on what did happen today regarding Chancellor
You see a lot in the term of flows. We're quite constructive on China. We think that China has a lot of policy measures that it can still take, and it already has. It's loosened its reserve requirement ratio, for example. It's now coming through with tax cuts. So it's coming through with measures that will counteract the tariff measures, and especially here on autos. That's one segment that had shown some weakness. The consumers weren't buying as many autos. So here they are adding some sort of stimulus to their automotive market.
Is this going to change the sentiment with regard to the trade tariffs in this situation?
Well, I mean, this in isolation won't, but I think in sum, all of the policy measures that China has and is going to take will eventually feed through. There's usually a 4 to 6 month lag in terms of stimulus reaching the hard data. But we think that it provides some opportunities because, as you know, we continue to be overweight emerging markets and China in particular.
What kind of opportunities?
Well, for example, technology is another topic that we have today for the discussion. There's China Internet, for example, are stocks that we think are stocks that provide some sort of opportunity. But overall, we think that sentiment towards global economic growth is far too negative because what the markets have been pricing in this sell-off is the idea that the Fed is going to choke economic growth because it's going to raise rates too quickly.
And you don't think that?
And we don't think so. And we think that, if anything, the broader outlook remains constructive. We think with rates coming higher in the US, that multiples need to be revisited, and you're not going to be able to pay 60 times foreign equity in future. You're going to have a more sober assessment of valuations.
You say sober, a more normal, perhaps.
Normalized long term. But if you take the automotive industry, for example, right now, what's being priced in is a long-term discount to valuations on a price to book, price to equity, regardless, pricing in a very negative scenario. So there are pockets of opportunities.
Okay, let's just focus a little bit on Merkel, though, because she had a disastrous weekend, undoubtedly, and she was very quick to nip things in the bud, to come out. She made a statement today. Do you think that there's perhaps, well, certainly the euro rose on what she had to say. Did the euro rise because she kind of set out a plan, she gave stability, or do you think the euro rose on the prospect that she's out?
Well, it's hard to say, but if anything, we think change in leadership at the CDU would be a positive, because we are in a situation where the EU needs to have very strong negotiators. They've got some tough battles to negotiate. They've got Brexit to negotiate. They've got the Italian fiscal deficit to negotiate around. And at the moment, with political parties, the driving seat of the EU, run by political parties that don't have support domestically, makes it very difficult. And of course, also negotiations with the US.
Doesn't this just add to the uncertainty, though?
Well, the thing is that it's been an open secret behind closed doors. Everyone's wanted Merkel to move on already for a long time, and the frustration has just been that no one is willing to step into the ring and take her on. And now she's basically given the okay for anyone to step forward who thinks that they could take her on.
Okay, let's talk tech stocks. IBM, this takeover of Red Hat. How significant is this? Does this really kind of throw the cat among the pigeons?
Well, I mean, a lot is being made of it because it's the first big deal in the tech industry since we've had the sell-off in the markets. And
biggest for IBM, I think, ever.
Exactly, yes. And people are saying, or the markets are speculating, that they might have been using market timing, the sell-off, as an entry opportunity. Knowing how corporate finance works, I don't think that's the case. I think they'll have been doing their due diligence already back in September before the sell-off. Nonetheless, Red Hat had a undeserved sell-off, we believe. We see good value in a company like Red Hat. And whether they paid too much or not still needs to be worked out. We still need the full details of exactly how the acquisition is going to be digested and what the impact is on free cash flow, for example. But what it does is it changes the investment case at IBM, because while we've been bullish on IBM longer term, those who have been bearish have been saying that they're too exposed to a declining mainframe business and not enough exposed to cloud, for example, or analytics.
Well, this changes everything
This
then.
changes things because now they are a serious competitor to the likes of an Amazon.
And with regard to what's happened to Amazon today on the stock, you know, it's kind of heading back down again for a second week. Do you think that's in any way to do with this IBM deal?
Yeah, how much market share they would be able to grab, or how much of a competitor they really end up becoming longer term, remains to be seen. But certainly, it would help people transition away from an Amazon type investment where you're paying for future growth rates to an IBM where you have strong free cash flow and you have strong balance sheets, and you now have a move into business areas that are growth again, like clouds. And if you take a look at the IBM share price reaction of down 2.7%, we'd actually say that that's very modest, and shows actually support for the deal, because keep in mind they did have to spend heavy on this acquisition, and they had to announce that they're no longer going to go forward with their buyback plans for the next 2 years. So that is a potential negative in terms of yield, and a minus 2.7 we would say is actually a sign that the market likes this deal.
And more generally on tech stocks, what are your thoughts?
So more generally, with the Fed rising interest rates, it means that you don't want exposure to companies that have high levels of debt. And traditionally, that would mean going into defensive stocks and defensive sectors like healthcare. But we think we're in a new normal where many of the technology stocks are defensive stocks. Take a look at an Apple, for example. Massive cash pile. If interest rates go up, yes, that impacts them. The cost of capital goes up for everyone. But for companies that generate their own free cash flow and finance their growth through their own free cash flow generation, they don't need to tap debt markets. So they are defensives.
So given Amazon and Alphabet both last week had less than good results, Apple this week, what are your thoughts?
So
Any predictions?
Steady Eddie is what we're looking for from Apple. So no big fireworks here. I think the new product launches that we heard about mid-September are probably the most important thing for Apple. And what we heard there was a confirmation that they continue to raise prices, because in the new model launches, the bottom end of the price curve, the successor to the iPhone 8, is going up by $50 in ASP. And the top end remains just as high as with the last model launches. So you have premium pricing here, and even rising ASPs by a hike in the bottom end of the pricing from their products palette, which means that this is a company that continues to be able to demand higher prices and therefore give shareholders higher margins.
And they always find they have customers here in Switzerland.
Absolutely.
Okay.
Penetration high here.
Swiss tech stocks haven't had so much success recently. I mean, are they facing the same difficulties or the same pressures as those in Silicon Valley?
Well, I mean, we think that in general, the rotation has hit everywhere, that there's been a rotation out of tech, which has been leading, and in part we agree with it, where valuations were too high. But again, others, where tech is strong balance sheet, we don't agree with it. And then also the components of tech where there's structural growth still intact, also we think that growth is worth paying for. So, for example, our research analysts in the Swiss equity brokerage sides, like Michael Furt or Takis Spiliopoulos, they, for example, still have strong buy ratings on the likes of a Logitech or an AMS based in Austria but Swiss listed as companies.
And they're direct suppliers to Apple, so.
Exactly. So there is some opportunity in terms of upside to target price in Swiss tech as well.
Okay, where else do you see opportunity in the wider market?
Wider opportunities, I think, in general, are such that we've seen now a consolidation in equities. Also, global asset classes have seen a consolidation now in October. What you've seen holding up has actually surprisingly been the commodities space. So there's been a real disconnect, for example, between what oil prices have been doing and what the energy sector equities have done, sell off, or what metal prices have been doing, copper, for example, and what metals and mining shares have been doing. So that provides some opportunities as well. We continue to like oil field services stocks, for example, because they benefit from increases in production, and production continues to go higher. And in a situation where prices are supported for oil, they should also be relative beneficiaries.